Navigating a shock-prone world, an IMF perspective for Europe. Thank you very much, Helge Berger, for being here, Deputy Director of the IMF's European Department, and thank you also to the IMF for organizing this together with EPC. We are going to look at the economic outlook for Europe, hopefully not getting too depressed, but also then wanting to have a conversation around what the causes are, what the long-term trends are, where we're going. And I'll have a few questions myself, but I will also open it up to the audience. So please be ready with your questions. I think it's a very challenging moment in not only European economic history, but also in the political history. Of course, what is happening in the world is having a significant impact on Europe, on Europe's economy, not least through the energy prices, which we're also seeing on a personal level, not just on a macroeconomic level. So very much looking forward to having this discussion. I was just mentioning this is actually the reinvigoration of a tradition we had in the EPC, that we would have the spring forecast of the IMF and then have a policy discussion around it. So it's very nice to resurrect that tradition. And thank you very much for being here. So we'll start with the presentation and then we'll have a conversation and afterwards we open it up. Thank you very much.
Okay, now that looks better. So I saw some old acquaintances in the audience. For everybody else, I don't know. Thanks for coming. Fabian, thanks for having us. It's a privilege to be here. I don't know whether we'll be depressing or whether we will just be realistic. But either way, let's try to set the stage. So if there's a word for the outlook, then it would probably be that it's sobering. And one reason for this is that we have to come to the reality that Europe is just operating in a much more adverse, volatile global environment. This is just a somewhat subjective list of shocks that Europe and other countries, of course, have been facing in the last years. And you can see that the frequency with which they have been hitting the region and the length with which they have been sort of impacting the region has been notably increasing. The most current shock is the adverse supply shock. We're seeing lowering growth and increasing inflation. And that is a challenge on its own, but it comes on top of the still ongoing, lingering effects of Russia's invasion in Ukraine, of the still ongoing trade tensions at the global level. And so I think just the policymaking environment for Europe's policymakers is fundamentally changed. The way to address this, and I come to this after talking about the outlook for a little bit, is to ask policymakers to go to a policy-making approach that is robust to very different and quickly changing scenarios. I think they also should be thinking about how to make the region more resilient to shocks, how to increase growth in a lasting way. So that is the second part of the policy messages. So what are we looking at currently? This chart tells you a little bit about how what we are currently facing is similar and yet different to the energy market ramifications of the 2022 developments. What you can see is that oil prices have rather rapidly increased, and both the level and the speed of the increase isn't too different from what we observed after Russia's invasion of Ukraine. It's a little bit different when it comes to natural gas, which is very important, right, for Europe, both for heating and electricity production. At the margin, there we have seen a notable increase of around 50%, 45% last time we looked, but it's not quite the same dynamics that we have looked at, had to cope with in 2022. Now, there's one element in this comparison that I think is a bit of good news in the sense that the energy mix, in this case, we're looking at electricity production in Europe, has notably changed in recent years. Now it will be, demanding a little bit much for rapid change since 2022, but even since 2020, we have seen a notable increase in the share of non-fossil fuels in the energy electricity supply. So these renewables now are close to 50% of production. So naturally, the impact of fossil fuel price increases is a bit mitigated. That's a glimpse of the idea of what Europe could be doing to harden the economy against these kind of global shocks. Right? And we can come back to this later. And I'm sure there will be time, Fabian, to discuss some of this. But of course, ultimately, energy prices are up by much. And that is what it's impacting our outlook. And it's not particularly a good one. So let's go through this and see exactly what we're looking at. We, maybe as a note on just how difficult the situation is, here on the left is a rather unconventional representation of what IMF forecasts, be it in the spring or in the fall, look like. It's one that is centered around scenarios rather than one point estimate of the future. You start by looking at the pre-war dotted line at the top. Sort of, we were hoping for a rather sort of moderate, but still there growth path for Europe. Inflation was supposed to come down. Clearly, that's not what we're looking at anymore. The baseline forecast, also called the reference forecast, that's the green line, is already notably lower, at least by European standards, so at every decimal counts, than what we had before the crisis. But things could well be worse. Right? An adverse scenario, which has much steeper price increases in 2026, would mean much lower growth. And a severe scenario where these steep price increases extend into next year would have even worse outcomes. I'll talk to you a little bit about what this means for the Eurozone and for other countries, but this is sort of at the EU level. So let's see where we are in terms of the forecast for the Eurozone. On the left, you see a breakdown how we went from 1.3 under the pre-war forecast to 1.1%. Okay, I see we are not helping you much with the way the scales are showing. So you have to trust me that the gray bar is at 1.3, and then the green bar there on the very left ends at 1.1%. And the red drop is the downgrade that we enforced because of the impact of the war. That's about 0.3 percentage points. So it's a quite sizable negative shock to growth. Data until end of February looked rather good, so therefore this blue upward push would have been what we would have done had the war not lowered the outlook. But what you really want to focus on in terms of understanding how things could be different under different assumptions are the adverse scenario and the severe scenario. They're notably lower than the 1.1 we're currently expecting for growth, and in the severe scenario, 2026 growth for the Eurozone could be as low as 0.3%. That is not a recession, but it's awfully close to a recession. At the same time, inflation would be higher. Now, we have roughly similar changes in terms of growth and inflation in the other part of Europe that's not Eurozone. So let's look at especially Central Eastern, Southern Eastern Europe. Worrying concern there is less the decline in growth, even though that is, of course, also potentially hurtful. but that inflation there is in many countries already rather high. So if you add to this the repercussions of the energy price shock, things are looking a little bit more worrying on the inflation front. So now, how close are we to this adverse scenario? One way to look at this, and here the scales are showing properly, is to compare forward prices, in this case for oil, to what we broadly assumed, both under the reference scenario and the other scenarios in the forecast. So this is, as of yesterday, I believe, the blue line. This is what markets are telling us what oil prices will be in the future. The green dotted line is broadly, it's an approximation, what we assumed under the baseline, while the yellow and the red ones are respectively the assumptions under the adverse scenario and the severe scenario. So clearly we're much closer in terms of energy prices as of today, right, to the more adverse scenario for the European and the global economy. But be mindful of the fact that this could change as market can change overnight. So, but that's where we currently are. I would be amiss to add that, of course, that is not the only driver of growth. Right, other things are happening as well. So let's take a little bit of a look at what else is ongoing. Here we go. So one other driver of growth is that we have seen some tightening in financial conditions, especially in the sovereign debt market. We have on the right, you can see sort of the some representative yields, sovereign yields going up. They haven't marched to very high levels, but they are definitely up, and that is part of the explanation why financial conditions, the way we measure them, have tightened a little bit. And so there's a question of how far will this go, under what scenario. There's a question of whether there's a risk that these pressures could ultimately spill over into the private sector. So clearly, this being the IMF, we will be monitoring financial stability risks going forward. Now, maybe a word about that problem that the CESE regions, or the Central Eastern, Southern Eastern European countries have. We realize we're generalizing across a large number of economies, but this higher rate of inflation runs the risk of making the competitiveness issue that comes from the cost side for these economies a bit more difficult. We see that especially in the Western Balkans, but also in some of the other CESE economies, the real effective exchange rate has been going up long before the current period of rising prices. And a driver that's relevant for the region has been that wages have been growing far ahead of productivity increases. And so if inflation now leads to higher wage growth, that is a concern that we need to keep an eye on as well. Now, if you look for tailwinds to growth, here's one. This is, looking at the example mostly of Germany, but also of other economies, the behavior of the public sector. So one of the drivers of growth remains, even under the baseline, that we have a significant expansion of public infrastructure spending, of defense spending, especially in Germany. Germany being a large economy, that matters for our forecast. That remains highly relevant, and in that sense helpful, because we have been calling for Germany to do exactly this for a number of years. So this continues to be a tailwind to growth. We have, of course, increases in defense spending across the EU in many countries, with some very sizable increases. They tend to be, these increases, slightly less effective in low and increasing domestic growth than infrastructure spending, mostly because so much of it turns out to be imports rather than exports. So that's the outlook. Now, what do we do in terms of economic policies? So to simplify this, this is what we need, right? We need robust policies that are ready to be deployed or adjusted to changing circumstances. If we cannot be sure what this year's or next year's outlook is, then we have to start thinking in scenarios. So should policymakers, and they should choose policies that remain correct or helpful, right, under different developments of the real economy. At the same time, the smart policy at the structural front is to invest in the resiliency of the European economy, and that has both a growth aspect, the higher growth, the more robust the region, but also a direct resiliency aspect, because a better European economy is also one that is more robust itself to external shocks. So now let's be a little bit specific. Let's take this to macroeconomic management. Let's start with a discussion of monetary policy. We see that inflation pressures have gone up, and then I move to fiscal consolidation, or what should continue and what not in this sphere. But let's start with a closer look at monetary policy. So, how are you mindful, right, of the different scenarios that we could be looking at as a monetary policy maker? Our advice is to be very, very clear sort of what your starting conditions are. So let's be precise. If you're an economy that still is looking at inflation rates that are relatively close to target, if you're in charge of monetary policy for a region that also broadly is in neutral territory in the sense of the output gap being broadly closed, if your monetary policy is looking at expectations of inflation that are still fairly well anchored in the medium term, then you have the chance to wait to learn more about how the economy evolves before you act. That sample of countries includes the euro area, where we expect the ECB to continue to wait, and then take action coming the summer. That is appropriate. You learn from waiting. You of course don't want to wait too long. So if inflation expectations are moving upward, if core inflation is affected more, policymakers need to be ready to step up. Now, there are other countries in the larger European region which are in a slightly different position. We talked about the CESI countries, where many places inflation is significantly higher still than inflation targets, and these inflation pressures have gone up considerably. So here the case for actually moving to a more restrictive stance is slowly but surely building. So this is roughly sort of how we go, how we think about monetary policy and what robust policies mean in this case. Now, fiscal policy, I hear that's a popular topic in Brussels this week, is another area where robust policies are important, but of course we also need to remain nimble in terms of how policy reacts to developments. The guiding principle here, in our view, is that we need to be very, very aware of what the actual fiscal space is that economies have. If countries have high debt and no or very little fiscal space, the urge to expand fiscal policy, to increase the deficit and spend more on energy support without offsetting it, needs to be resisted. Right? The consolidation needs to continue if you're out of fiscal space. If a country sort of has more fiscal space, automatic stabilizers can absolutely work, but the underlying principle is that we have to be very aware of what can be done. Now, is this a problem? We clearly do not want expansionary policy in a world where inflationary pressures are going up because we're facing an adverse supply shock. Right? That would make the life of central banks even worse. That's true. But it's also true that the kind of policies that policymakers seek to deploy to support vulnerable households don't have to be awfully expensive. It is a matter of how these policies are being deployed. Now let's be clear what a good policy response to this pressure that households feel at the moment looks like. It should first be temporary, right? Because we think the shock may be not permanent. It should be well targeted, so we should not have broad-based measures that support everybody in the economy. We want to focus on the most vulnerable households. And it should be a policy that makes sure that the price signal, that the energy price increase sort of remains in place, right? We want households and firms to react to higher energy prices and, therefore save energy. So this is critical. Now, if you do all this right, the actual cost of these measures doesn't have to be deficit altering at the macro level. Actually, this can be quite affordable. That's what our analysis shows of the 2022 episode. This is what our analysis shows for the current measures. The problem with the measures is that most countries are deploying some form of price distorting measure, and that of all the measures that have been taken across all countries that you see on the left, almost 2/3 are such that they distort the impact of higher energy prices on consumer and corporate behavior. That's not the way of going about this. We had an intervention yesterday at the Eurogroup that laid this out, and there's a paper that was published. We can point you to that just yesterday. For now, the problem is mitigated by the fact that the sums we're talking about, as we survey countries, aren't too high. But of course, this could change if we are not careful. All right. So robust macroeconomic policy is very important. On fiscal policy, we need to do the right thing as we sort of try to protect the most vulnerable households. But what about resilience? What about sort of the more structural policies? Here the point is to be smart about energy policy. So I'll talk about this very briefly. We need to be smart about how we go about economic security. I know this is a popular topic with EPC. And we need to think about which reforms in the structural sense are relevant both at the country, at the European level. But the general gist of this should be how can we help Europe as a region become more robust to this more adverse global scenario. All right, so the first point. We need to work to fend off the energy shocks with calibrated policies and an integrated energy market that favors renewables. If it's correct what I said at the outset, and I deeply believe that's true, that the increase in renewables has added already to the resiliency of the European economies, then giving up on the idea that energy security comes from adding to the renewables supply in the economy, would be bad. That's not the way of going about this. What we need to do, in this area is we need to stay the course on the energy policies that are in place. That has immediate implications for the ETS, which is guiding private sector investment, which is guiding private sector behavior. And so we need to continue on here and hold the course in a steady way. Another aspect is the the deepening in the integration of European energy markets. If we have more renewables, we need to integrate the energy market across the continent. We need more interconnectors. We need a blueprint for this so we can plan accordingly. And that will help us sort of make good use of that increase in renewable capacity. And overall, this will also help us to lower the energy prices for Europe on average, which have gone up with Russia's invasion of Ukraine and haven't quite come down ever since. So that's the first point. Energy markets, energy market integration, stay the course on energy policies in Europe. Now, what about economic security? It's clear that building resilience for the European economies also means evaluating what strategic vulnerabilities are. there are many strategic vulnerabilities. Here's just one example to illustrate the fact. It's a hypothetical scenario about a sudden stop in rare earth supply at the global level and what it could mean in terms of GDP impact. We have ongoing work that we will be presenting in Brussels in a few weeks. There will be a working paper ultimately available. So it's important to take a look at this, be rational about this, and understand where the pressure points are. Here is one. Now, what do we do about this is a different question. There are many proposals out there. Our plea is to look at them carefully in terms of their benefits and their costs. Some of these proposals have higher costs than they have benefits. We need to make sure that we don't that we keep global trade prosperous and don't accidentally do damage that we don't intend. So there are some proposals out there, like the Industrial Accelerator Act, which aim a bit more broadly at strengthening of the European manufacturing sector. And here we would say that has very little to do with what needs to be done in terms of economic security issues like the one that's being illustrated here. So we need to be careful and look at these individual measures and see where the costs and the benefits are well aligned. A last set of points, finally, on the general strength and the resiliency of Europe's economy. I always find discussions that talk about resiliency surprising when they look to the outside first, right? Trade policies matter. We need to have diversified trade. We need to have a working global trade system to support economies like the European one. But a lot of the source of the strength of the European economy lies within. A more integrated single market, in our analysis, has enormous positive repercussions for Europe's productivity, for Europe's investment dynamics, and if you pair it with the adequate domestic reforms, you could make some quite meaningful inways into improving GDP growth, total productivity gains of a best effort in terms of domestic reforms and deepening the integration of the single market could be around 20%. That would yield an additional investment push of around 800 billion euros, which will ultimately increase GDP per capita by 35%. That is closing the gap to the United States. So a lot of potential in this area. And if we are sort of looking for the areas to focus on, here what we're featuring is the product market integration within Europe, so services and goods trade, but also labor market mobility. And you would add a discussion here of financial market integration, where we know that there are still areas that need completion. The banking union, it's not news to anybody in this room, is far from complete. The capital market, if you think about equity markets, is still highly fragmented, both at the technical and the institutional level in Europe. Venture capital is also fragmented and generally sort of small in terms of the supply that's available to European economies. And so here's another area where we can add and this would promise even higher payoffs in terms of productivity and growth. And now finally, what not to do. There's a lively discussion, I understand, of reforms of competition policy in Europe. And while, of course, it is adequate to modernize the conceptual thinking around competition policy, mergers and acquisitions, it's also important to not throw out the baby with the bathtub, in the sense that if your rules are fine, then why change them at this moment? Because there's a need to, or there's a political ambition to scale up. So this is an illustration of just how fragmented one particular market in the services sector is in Europe, right? This shows you mobile broadband market shares within each country, and you see that predominantly in these three large economies we're showing here, it's the national operators that still dominate that. So allowing in this industry or any other industry, national mergers beyond what is currently sort of the practice would create larger firms, but it's unclear whether this would create European champions. Indeed, it's unlikely that it would, right? The way to do this is to integrate the single market in this sector and others, allow competition to evolve, unfold across all these markets. Then you have contestability improving that will allow you to have a different approach to the implementation of the rules, but otherwise the rules are fine. So let's be careful not to relax merger rules in still fragmented market, but it's a different ballgame in an integrated European market. That's the final slide. I just leave this up here before I join Fabian on the stage, and I've been told to press one more time to get our handsome faces back up there.
Thank you very much. Sobering, I think, is a good word to describe it. I particularly appreciated the slide with the frequent and overlapping shocks. I think it's one I will happily borrow. I would add a few political ones on that, which I think then shows really that, as we have said, that we've been in a perma-crisis ever since the economic and financial crisis.
Feel free to make it your
own. But that also raises a question for me. Clearly, we've had these challenges, which have also prompted many policy responses. We've reacted to all of these crises. What is the cumulative effect of something which has been now going on for almost 20 years?
I mean, Europe is not the only large or small economy that has been facing that more adverse, more volatile global environment. Trade tensions affect every country and so on. But it's true that Europe has faced a fair share of adverse shocks. I think on the one hand, it has been creating some scarring in the economy. We talked about the elevated level of energy prices coming especially from the natural gas segment that was triggered by Russia's invasion of Ukraine. This hasn't returned to normal. So, European consumers are still paying for that ongoing shock. If you step back a little, further back in time, I would say there's one upside, maybe the wrong word, there's one positive effect that came out of this onslaught of global challenges, and that is that Europe has evolved politically, right, during this time. I remember being in Brussels for the first time during the euro area crisis, a completely different world, and some of the people in the room will remember this. We didn't have an ESM. We were trying to figure out sort of who would actually be there in Europe as a counterpart to the help that was offered by the IMF. We did have ministers meeting, but not a Eurogroup in the sense of it being the coordinator and accelerator of joint decision making at critical times. Think about what Europe delivered during COVID, joint spending during COVID, joint financing of the spending. Think about the sort of longer moving, slower moving, but yet sort of real improvements in the single market along some dimensions, as imperfect as it still is. So I think Europe tends to evolve in spurts. Outside pressure often plays a role, but we have come a long way, and I would would hope that Europe will continue to evolve, and that will definitely help with all the problems we have been discussing.
You mentioned that we have had policy responses over that period. Before this current crisis hit, of course, we had on the European level a big focus on competitiveness with the second von der Leyen Commission. I'm wondering in how far, because you didn't mention the agenda which is there, wondering in how far that is influencing the forecasts, and also how, if you like, appropriate it is given the changed circumstances.
So we note and we welcome sort of the initiatives that the Commission and European policymakers have put out there and have endorsed towards the single market. If this is going to be one Europe, right, it should be a Europe with one very powerful and well integrated single market across all its dimensions. And I ran you through some of the numbers we have been producing in this area, and I can just only repeat, or let me, if you will, repeat just how mind-boggling so the gains are that could still be had by completing the single market agenda. If there are reforms out there that, however difficult they are, have the potential to lift European GDP by 30 or 35%, right? That should be a valid goal. And this is how we look at the single market agenda with some hope. And we would hope that after the endorsement by leaders, the follow-up by ministers and governments will be there and will deliver on this. We're careful in incorporating the gains from this reform agenda sort of without filter into our forecast, because we understand it's a very difficult political process. And I would stress that it's less about the plans which are there and cover some of the, or address, at least in first steps, some of the core areas. But it's about the difficulty of finding the common political will to actually implement this. And there, a lot of, I think, attention, falls on member states themselves. It is member states that, for various reasons, tend to gold plate European reform ideas. So we need to work on harmonizing regulatory frameworks, and that starts at the domestic level. So to pick just one of the items on the single market reform list, the 28th regime is helpful, not because it will completely change the way European corporates work. It will make an impact, but there's much more to do. But it's helpful because it will harmonize at a core area of corporate Europe what needs to be harmonized, and it will hopefully help guide member states to support this, right, at where they still have national sovereignty and will need to support it.
Turning from positive policy changes to negative ones, we are facing a global environment where certainly what we've seen from President Trump, we have increased tariffs. We have also the continuous threat, as we have just seen in the last week or so, 25% more on the car industry. Just wondering how far this global environment has played into the forecast. Obviously, the latest iteration you can't build in, but also in how far that makes it more volatile, less robust in terms of what you can forecast.
So we absolutely do our level best to incorporate the changes in the global tariff landscape, the impact of these trade tensions that, of course, exceed what happens to tariffs and also includes any other trade policies. into our forecast. And there are two main challenges. One is, higher tariffs just mean more expensive imports and exports. That tends to depress economic activity because it depresses trade. Uncertainty is another culprit here. Firms that do not know, what tomorrow's export-import framework is going to be in terms of regulations, but also tariffs and their ups and downs, sort of will be more careful when they invest. So this is included in our forecast. And if you look at the way we reason for our global economic forecasts, trade tensions continue to play a large role, even though right now we ultimately, like everybody, are also very much focused on understanding what that new shock, right, will layer on top of these existing ongoing issues. But that goes back to what I laid out earlier. You need to look for policies that make the European region more robust and to these shocks. That means we need to strengthen growth, and we need to look for ways in which the economy sort of can adjust to shocks. To one aspect, for example, that is often under discussed is how financial market integration can help with resilience. A much more integrated capital market in the holistic sense, joint equity markets, institutional investors investing across the EU, banking union being completed, so banking business being delivered across borders, venture capital markets being European in level rather than country by country. One underestimated aspect of this is that it would help tremendously with market-based risk sharing. Right? A global shock has very different impact on different countries. So if Europe more than today was holding a balanced portfolio of national assets, the impact on each individual country would be mitigated by this. So that's something that's very much at play in other integrated economies like the United States, and much less so here. So market-based risk sharing, one of the lower hanging fruits on the financial market integration front.
Turning to public spending, you mentioned that the German expenditure on defense and security is helping. It's holding up the overall growth rates, even though it's not very impressive. But what we have seen in the past is also that given the fiscal problems, that sometimes we had the recommendations going more towards austerity, towards less spending. Is this not a moment then which would invite some consideration of expanding spending at the European level, given also the fiscal constraints we have in other countries than Germany?
Very good question, and I would say that it's clear to us and to many other observers that there is definitely room to grow in terms of what European level provided public goods go. A larger European budget would allow for the provision of public goods at the European level, where some of them should be provided. Think about defense, but think about climate and other policies. So in that context, it is always appropriate to think about how to make progress in this direction, which we all understand, and you probably much better than I do, which are very complicated politically. But if there's an economic case to expand the role of the EU budget, then we should try and look for ways of making progress along these lines. That is true now as it was before the war in the Middle East started. So in that sense, yes. We need to think about what this would require in terms of spending. We need to think about how this can be financed. Some of the public goods come with public investment. Think about the energy market integration, expanding on the European grid. So there, obviously, because investment is an expenditure that over time pays off for future generations. Some debt financing is appropriate, and European policymakers should look at this. But I want to emphasize sort of the timelessness of that principle as opposed to the conjunctural needs.
We obviously have many challenging aspects of the economy. How do we communicate this to populations, given also what I would say is a significant risk of stagflation, so high inflation, low growth, or even recession, a very severe public finance crunch, energy prices, which of course don't only affect industry but also households. What is the kind of messaging we have to give to populations? What should we do about expectations?
I think we need to be honest about these challenges, right? Europe being confronted with a more adverse global environment is not the policymakers' problem alone. It's everybody's problem, sort of, as Europeans, right? That is just the world which we're living in. So part of an honest assessment of this economic circumstance is to be clear that if global energy prices are increasing, there's no matter of financial or fiscal engineering at the national or even the regional level that is able to in a permanent, sustainable way to deal with this. So we need to invest in our energy security. We need to invest in our electricity grid across Europe, and so these are important priorities, and we need to connect the dots. We need to argue and explain how these things, while they're also costly, sort of are probably medium term the better investment in our energy security than short term price-based measures at the fuel pump. That said, people are hurting. So it is critical that policymakers, because that's the right thing to do, sort of help households that are particularly affected by this. I think our point would be, if you do this in a smart way, it doesn't have to be as costly as it is when you do it in a broad-based way. And so the right policies don't have to be breaking the fiscal bank. But it starts with honest communication about how the world has changed, and then being honest in terms of the policy making, and do a good cost benefit analysis around all these measures.
I'll open it up in a minute. Just one more question, probably the trickiest one. Because some of the reforms you've mentioned, the policy changes you mentioned, have been in the debate for a very long time. We've been talking about capital market integration. We've been talking about switching more to renewables. And despite what you have shown to be a very sizable price, 35% is an enormous price. Why are these not happening? What is the barrier which prevents us from obtaining those gains which you've set out?
That's a difficult question, and I wish we had all the answers. But I think one aspect that's relevant here is that it's important to look at these reforms in a holistic way. Each individual reform area, and we can get more granular in the discussion if that's helpful, sort of affects countries differently, affects within country regions differently, within regions sectors differently, households of different income levels differently. And I haven't even started to talk about how corporations fare under these reforms. The thing we know, and that's what our numbers are showing us, that overall there's an enormous benefit to be reaped. And so it's important to understand that that a holistic approach to these reforms is what benefits everybody, and to to explain this well, and then also to be smart about how we go about these reforms simultaneously and or sequentially in a way that can actually build winning coalitions around these reforms. So just to give an example, the numbers that I showed you, they started with a 20% increase in productivity coming from domestic structural reforms and product market, labor market, and EU level single market integrating reforms. We've done this at the regional level. So we looked at the smallest allowable in terms of the data that's available scope, and we found that for all EU member states, on balance, right, these nations of Europeans would benefit from these reforms. Within each country, there are regions that benefit more or less, and there may be the odd region that doesn't benefit from a holistic set of reforms. But we don't have to reinvent the way European level fiscal policy works to ensure that every country wins from a holistic in a holistic reform package. Right, the existing ways in which countries, nation states share income and wealth through their tax and benefit systems would be sufficient. So that's a rather stark result. Now, it's a simulation. There are many caveats. This is an area that we can discuss much more. But at least to me, it's a hopeful result that sort of complete reform packages, sequencing smartly and looking for coalitions around this could potentially break through.
Thank you very much. I am looking for questions. I pray take 2 or 3 at the same time.
Hi. Is this on? Can you hear me? Yeah. This is Mission of Australia, Raul Villegas. Thank you very much for the presentation. Very interesting. I had a question about the structural responses that you outlined. You might have answered it in the last thing you said, but I would still like to ask. The only structural answer response I missed was the debate on common debt, European safe asset, joint borrowing in its different ways, and next generation EU or fully mutualized debt, whatever you think of when you hear that term. Do you think that is an appropriate answer in the current context, but more generally speaking, to address things like investment in renewables, as it would increase liquidity and lower financing costs? Or as you said right now when you were wrapping up your presentation, the current fiscal rules are enough, are good enough, and reform should focus on other areas like the single market and other types of market integration. Thank you.
I'll sit behind you, and then I'll take a third one there.
Thank you very much. Naïm Courdemans from the European Central Bank. I have a question regarding another shock that is ongoing or is looming, which is the China shock. We've seen that in the first quarter of 2026, the export from China to the EU have never been as high. On the contrary, import from the EU has decreased very significantly, and the trade surplus of China has never been so high. There are many reasons behind this. We know the subsidies, the rerouting from after the US tariff, undervalued renminbi, but also higher productivity and the willingness of China to control supply chain. How do you, is that included in your forecast, this type of risk? And how do you assess, looking forward, the risk for the European economy of this China shock? And what would be, that may be tricky, but what would be your advice in terms of policy to the EU policymaker? Thank you very much.
We all know, Lucio. I start with this intervention because it is the most thought-provoking. So on the macro, right? So we are all in on the textbook response at the macro level, right? We need monetary policy to be careful and watch inflation expectations and and core and see whether there is movement, and even in a region like the eurozone there may be, and then we need to make sure that our monetary stance is in the right place. Depending on what will happen in the next few months, right? This could even mean that the nominal policy rate will have to move just to keep the real policy rate, and therefore the monetary stance broadly aligned with the conjunctural needs of the economy. So we're in agreement. We're also in agreement on fiscal policy. The appropriate macroeconomic monetary stance is a neutral one. Fiscal stance is a neutral one. There's no need. Indeed, it would be detrimental to the macroeconomic outcome if fiscal policy at the aggregate European level moved into an expansionary stance. That's just not what we need. Right? It would just add to excess demand, and that's not what we want. Now, that doesn't mean that at the household level, there aren't households, right, that in these circumstances, even within the existing social benefit systems, aren't sort of pressured beyond what sort of society is wishing to tolerate, right? And then the question is how to go about it. We think that there are ways of supporting the most vulnerable households without making a dent in the aggregate fiscal stance of the European Union or the euro area, or indeed of any of the individual countries that we cover when we talk about Europe. So we're at the same page, and but we are very, very adamant about, and that's the last point, that the support should be done in an income supporting way, right, rather than in a way that artificially lowers the prices of European energy supply, right? Because that, for the very reason, right, that you mentioned. First, it would be counterproductive for Europe itself, because it would mean that European energy demand is higher than it otherwise would be, which will impact Europe as a large economy, global energy prices, and be counterproductive. But of course, it also has an impact on the way how this plays out globally. The world does only have the amount of energy that is currently supplied, and so that is actually where our advice comes from, right? So thanks for helping making this clear. Let's stay with the fiscal policy angle. Common debt. As I alluded to earlier, there is a good argument to be made for a larger European budget because there is unmet demand of European public goods, right? By which we mean many different things. And so we have made proposals for a modest increase in the EU budget to make sure that that more of these public goods at the European level can be supplied. To the degree that conjunctural ups and downs of the economy mean that that the available level of revenue that's there to finance these public goods goes up and down, but the needs to spend remain the same, there's a natural cause for natural argument to endorse common debt to help smooth government spending through time. We certainly are in favor of this, as we are for any fiscal entity at the regional or government national state level. And then there's separately an argument that can be made for financing European public investment that is entering the production of European public goods through common debt, simply because the benefit of this investment sort of accrues not just to the current generation, but also future generations. So think about expanding the European interconnectors in the electricity market. So yes, right, we are we are in favor of common debt for purposes that are central for European public goods. And one of the advantages of this would be that they would add an element of fiscal risk sharing, because revenue flows from different countries vary across the business cycle, and it's a different topic, but very interesting. So on China, we look at all the large economies in the world. We are mandated to look at global imbalances, by which we mean both trade and financial flows. One of our strongest recommendations here is that all countries should be addressing domestic imbalances that will, ultimately help us to also reduce global imbalances. That applies to Europe as it applies to other economies. And so to the degree that China addresses domestic imbalances, some of which you mentioned, this will also contribute to reduce these global imbalances and address some of the issues that you mentioned. I would just make an additional empirical observation and then go to a policy recommendation here. Chinese export growth globally is on a trend. So some of the increase that we currently sort of commenting on is just a continuation of this. So it's not as in that sense, not new news in that sense. But what is the answer, right, to a more competitive global environment for European firms? It is strengthening the accessibility of domestic markets, right? If you don't have an integrated single market for products in Europe to a large degree, we still don't have it, then that's an area to expand on and to create growth and domestic demand that will strengthen Europe, sort of even as the global environment becomes more adverse. And so I would say the path to higher income in Europe, to higher growth that leads to higher income, remains very much in the hands of domestic policymakers. Right? If we do some of these structural reforms that we have identified at the domestic level, if we continue to integrate the single market at the product and also the factor market level, this will create enormous income growth that will make some of these external headwinds far less important. So that's where we think the future lies.
Okay, thank you. Final round of questions. There was one here.
Thanks. Is this on? No. Is it? No. Okay, thank you. Now I have two questions actually. One is on the forecast. So you showed a slide in which you were showing the different paths of oil prices under the different scenarios, and you stress the fact that actually current market developments have been so that we are now at current. So the recent evolution of prices is such that we are more now at the adverse rather than at the baseline scenario. But going forward, what can we expect? Do we have any information from inventories of oil, from destruction maybe in production capacities due to the strikes from the war? Anything that can tell us whether for the medium run we can expect to be closer to one of these two paths, or even to the more adverse path, if really there is a distraction in oil production and refining capacities. No? The second question is related to industrial policies. I can see that there is around quite a lot of enthusiasm about industrial policies, certainly for good reasons, because other countries are misbehaving. So one thinks a priori that the appropriate response to that misbehavior is misbehaving as well, in introducing tariffs or other perhaps even blunter instruments, no, to prevent them from supplying certain goods at a certain price, no. And another one is strategic autonomy, of course. But yeah, I don't know whether we have a proper assessment of the costs, which probably come more in the short run. There are efficiency costs if we, in terms of the supply chains, we give up on importing certain goods from China, for instance. There is even an impact on upward impact on inflation if we were to do so, which is something we specifically at this moment we don't want. And even one could think of some of the, Chinese, they seem to be subsidizing exports of EVs to Europe. They seem to be subsidizing them heavily. But if they are more efficient in the production of these cars and they want to sell us cheaper cars which are financed by the Chinese taxpayer, maybe we should not be concerned about this. Thank you.
I see another question, so I'll add one myself. And it goes a little bit in that direction. I think you mentioned economic security. As you know, we're doing a lot of work on that. I'm wondering whether we are facing a different trade-off now between openness and security, and whether we have to also accept that if we are in a less interdependent world, that also means that our potential growth rate is lower. So do we have to pay a price for being more secure?
You keep the complicated questions for the end. Well done. We have looked at industrial policy rather intensively in the last 2 years. And I think one important lesson that is particularly important in the European context is that there are enormous spillovers from that. So I'm not talking about large Asian economies. I'm talking about spillovers within the 27 EU member countries. And we find that support for any one firm has benefits for this one firm, but has detrimental effects sort of for other firms around the corner or in a different country. And that means, right, we need to coordinate industrial policies wherever they're necessary. I'll talk to whether they're necessary or not in just a second. But to the degree that you're conducting industrial policy, it needs to be urgently coordinated. That is critical. Otherwise, we cannot assure a welfare gain for the entirety of the European economy. And so this is where as much pressure as it is under, a framework like the state aid framework actually have a very important role to play. So if you conduct industrial policy, do it in a coordinated way. Also, accept that industrial policy is not a cure-all for all the problems that are ailing European economies or the European economy in the aggregate. We talked about the need for domestic reforms. We talked about the single market. That is a much better way, a much healthier way to economic growth. Industrial policy at a large scale will not deliver this, right? The historical track record on industrial policy at a large scale, you can even call it that, right, is very weak. So industrial policy is a tool that has a role to play when there are well identified market failures at the sectoral level. And even then, let's consider our measures. Let's make sure they're sort of well targeted at the problem at hand and don't lead to these spillovers that could be detrimental for others. The strategic economic security style policies, I rushed through this in my last few slides, similarly are an area where we need to be very careful to deploy detailed cost-benefit analysis to understand what the benefits can be, for example, reducing the strategic dependency on a particular group of importers, and the potential damage it does when we, through whatever means we're applying, we're going to take measures domestically to develop a domestic supply that can sort of mitigate that risk. There may be places in which this is the correct way of going about it, but even when we identify trouble spots along these lines, we need to be very careful, right, in understanding what the minimum inversive intervention is that deals with the issue at hand. And so so what is it we can do instead, right? If we step back from global trade in general is on the retreat to some degree, a source of growth, not only because it helps us in terms of our exports and imports, but also because it's productivity enhancing in ways that we have, analyzed for a long time as an economic profession. So what do we do? Where's growth coming from? Well, clearly, right, the reforms I've been talking about are very meaningful. We've done calculations that show how little additional integration of the European market sort of would be required to compensate some of the tariffs that have been deployed in recent years. It doesn't take, a full-out reform to deliver these 35% of GDP gains to compensate for higher tariffs that in effective terms have been deployed in the last few years. So a little of domestic reform will go a long way in compensating for losses in productivity and growth on the trade front. But beyond this appeal to reforms for the single market and to addressing domestic structural reform gaps, another aspect that's really important and we haven't discussed so far is making sure we diversify, right, our trade partners. And globally, we have seen an increase in multilateral and bilateral trade agreements, for regional trade agreements and bilateral ones. That is very helpful in a world where sort of the global trade order is sort of under duress. So the Mercosur agreement, other agreements that the EU has recently signed off on and is now applying, will help us not only mitigate some of the negative headwinds from global trade developments, but they will also help us on the economic security front, right? Because it will open up the world to alternative sources of imports for critical goods beyond the ones that we currently have as tariffs go down and regulation gets adjusted, right? So that is another policy tool the EU and other countries can be using, and we welcome very much what the EU has done there recently.
Thank you very much. We are out of time. I think there were a number of areas we could have gone on. Also, as you mentioned at the end, a number of areas we didn't touch on. But it has been a very interesting discussion. Not sure. I feel very uplifted. Also because I fear that we probably need to take the adverse scenario as a baseline rather than as something which might or might not happen, given the headwinds we have in so many different areas, including also politically. I do hope that our baseline is not that we keep returning to the potential gains which could be had but are not realized because we do not manage the politics of it. But I think it's a good illustration of why we should tackle these problems and maybe why we should less talk about the reports from Italian economists, but rather actually do them. So we shall see how much progress we make in Europe. But thank you very much, Helge. Thank you very much to IMF and also to all of you for being here for this discussion. And I'm sure we will continue to follow this discussion and also interact with the IMF. Thank you.
Thanks for having us, Fabian.